everybody. Thank you for coming. We're going to spend the next 10 or 12 minutes talking a bit about what's going on in the global economy, what are some of the risks to the global economy, and then we're going to look at the issue of climate risk. How are companies thinking about it? How are governments thinking about it? How are regulators thinking about it? And how should you think about it to be able to continue thriving? So first, when we look at the economy, we look at the World Bank forecasts. And you can see that this is a pretty rosy forecast for global GDP. Next 5 years, about 3.6%. But this isn't the same for the whole of the global economy. So there is a divergence between developed economies and emerging economies. And that divergence can be seen when we plot out what's the forecast for developed economies. So not only a much lower growth rate, but a downward trajectory of growth. Of course, for everyone in this room, what you're probably most interested in is what is going to happen to the economies that are the highest consumers of oil. So if we look at the top 5 economies with regard to consumption, we start with China. And China's GDP grew in 2018 by about 6.5%, right? But what's the outlook going forward? According to the World Bank, the outlook is for that growth rate to slow, and it is going to slow for several reasons. One, China is facing demographic problems. They're having a decline in the growth rate of their working age population. Second of all, they've reached the limit of what they can do in terms of debt financing. Non-financial corporate debt in China is over 165% of GDP. In the US, just to give you a benchmark, it's close to 50%. And a few weeks ago, Fed Chairman Powell gave an in-depth speech that I happened to attend at the Atlanta Fed conference about why this level of debt, near 50%, was a worry to the central bank. So juxtapose 50%, a concern, versus 165%. Finally, there is, of course, the ongoing trade war and the embargo, if you will, of technology firms from China. It started with Huawei. It is continuing. The next largest energy producer is the United States. And of course, we had a banner year of growth in 2018. The expectation for 2019 in the coming years is for growth to return towards potential GDP. That is the growth rate that can be sustained when we add up the growth rate of the labor force plus the growth rate of productivity. Then if we go on to Japan, the 3rd largest energy consumer, it's not as rosy a picture. Japan has been battling demographic challenges for 3.5 decades, and of course you see not only a downward trend, but a very low pace of growth. Finally, the bright spot in all of this is India, where structural reforms are still hoping to give a boost to GDP, and the demographic picture is extremely favorable. But of course, India is only 3% of consumption. We move on now to the final largest energy consumer, Russia, and the picture looks very similar to Japan. Similar demographic challenges and structural challenges emanating from the way the economy is run and the way the government is run. Now, these are the top 5 country consumers of oil, but we also have to consider the euro area, right? While it's a group of countries, they manage their energy consumption in a similar way. They are binded together by similar regulations and obviously a uniform monetary policy. So what's the outlook for the euro area, which is 15.5% of GDP, but only 4.5% of consumption? And we can see that 2019 is not forecast to be robust growth, but that there is a hope that growth will continue upward. So how many of you are surprised that in the next 5 years, the World Bank has forecast no recession anywhere? Right? Well, that is because generally economic models of the type the World Bank uses do not come up with recessions on their own. Models have to be shocked to create a recession because models assume this invisible hand and that things adjust within the economy and there's perfect equilibrium and the economy continues to grow. So what causes an economist to say, wow, now's the time to shock my model? We look at a bunch of different indicators, but the best indicator is actually the yield curve. And in particular, the difference between the 10-year yield and the 3-month yield. So if we go back to the 1980s, right before the 1990 recession, before we'd even announced the Gulf War, which a lot of people, when they look back, say, well, we had the Gulf War, that's why we had that recession. No, it's not. We start to see the yield curve heading towards inversion before the Gulf War was even announced, right? And then what happened? We had a recession. Here's the shaded bar indicating recession. And if we look at every single time right before a recession, we see the exact same pattern, the yield curve inverts. Now, why is this a recessionary indicator? It's a recessionary indicator because it's a clue about what the bond market is thinking with regard to the economy. And of course, the bond market is many times the size of the equity market. Second of all, it gives you a window into liquidity conditions. Banks borrow at the short end of the curve, lend at the long end of the curve. If the cost of borrowing becomes relatively higher than what they are receiving when they lend out that money, they're going to tighten liquidity conditions. And this obviously reverberates throughout the entire economy. And what we see now is an inverted yield curve, right? 10-year minus the 3-month is below 0. So we know it's time to start thinking about shocking our model. What is the next step? And the way that I like to think about this is sort of like a Jenga tower, right? If you have one shock and you pull out that one shock, probably the economy is not going to collapse. If you have 2 or 3 or maybe 4, it will be enough to cause the economy to collapse. So one of the things we are looking at right now is the US housing market. We've had negative investment, residential investment in housing, for the past 5 quarters. We have high levels of corporate debt here in the US and obviously globally. And as I mentioned, China is under a lot of pressure. There are economists who actually think that China's growth rate is currently negative, even though official figures have it growing at close to 6%. So let's pull out those blocks from the Jenga tower. Might not be enough for it to collapse. It's wobbling, but it's not collapsing. When we layer on a trade war, that is probably enough for this Jenga tower to collapse because all of these other things are also occurring. So we've gone through and shocked our model with various things, and we have a recession timing of sometime in late 2019 or mid-2020, depending upon how these things unfold. All right, so that's the economy. Let's talk about the next major risk or issue facing the energy market. How many of you have heard of the book, The Gray Rhino? Oh, good, all right, I'm gonna get to introduce you to a new concept. The Gray Rhino was a book written by my friend Michelle Walker, published in 2016. And she posits that a gray rhino, unlike a black swan that you don't see coming, is a risk you see coming. It's there on the road, it's big, but yet somehow we don't do enough to mitigate the risk. And why is that? Well, one, human beings tend to discount things that they don't fully understand or feel are too complex. So risks can be, even though they're seen on the horizon, they can be discounted because getting to the bottom of them is too difficult. We also tend to have an optimistic view that we see this risk out there, but we are going to be able to manage it better. Maybe the rest of the industry won't do as well, but we are superior. We will be able to manage it better. And what are the main components of this risk that we call climate risk, and where is it coming from? Well, it's coming from shareholders, right? There's a growing focus on ESG investing. It's still nebulous. What are those criteria? But it's definitely growing. It's coming from other industries. So we're going to look in a minute at data around how many industries in the S&P 500 have listed climate risk as a material risk to their bottom line in their annual reports. And then finally, it's coming from governments. Central banks are actually beginning to consider if climate risk is a risk they need to think about when pursuing their mandates. So unsurprisingly, back in 2006, very few companies were thinking about climate risk. But as the decade progressed, you started to have more and more companies consider that climate risk was a material risk in their annual report. And utilities and energy companies, not surprisingly, led the way in this. But let's look at some other industries. So this is where the bulk of the S&P 500 sits, from about 0% considering it a risk to something like 70% considering it a material risk. And of course, it's industries you might expect. The food-producing industry, right? If you have adverse weather effects due to climate, that's going to impact food supply and food cost. Insurance companies, they're obviously very impacted because of the assets that they insure being adversely impacted by climate risk. Finally, we have the group of companies that still don't see it as a really significant risk, although you can see the trend is slightly upward, with banks starting to consider it at a more rapid pace. So this is a focus of not just the energy industry, but a whole host of industries, many of whom may be counterparties to the energy industry. So let's back up for a second. Aren't we looking at better forecasts for CO2 emissions? So this is where we were in 2006. Then came this forecast. It looked pretty scary, right? A really steep increase, an increase the same pace we saw from 1980 to 2006, going out to 2040. But here's what happened. Even though we had a major recession, we rebounded and went along this trajectory until 2015. And then you see that in reality, CO2 emissions flatlined. Why is that? I think it's for several reasons. First, China's GDP was slowing, and their CO2 emissions actually declined from 2015 to 2018. 2018, they rose again. So that's one big reason. There was a switch from coal to gas in many, many developed economies. And finally, there was a tipping point for renewables, where the deployment and cost of renewables became large enough to impact this picture. So here's the new forecast. It's actually pretty optimistic in my view. It would be great if this is what we get, but I think because so much of the energy consumption is coming from countries like China, India, and Russia that are unlikely to make significant changes to their CO2 output, this is a concern about whether or not we stay at these levels that are forecast. So how can I make that assertion? Well, it comes in part from how economists think about climate risk. And this is from a paper put out by the Bank of England. And we look first at physical risks. So damage to property, plant, and equipment. And this can come from extreme weather events, like the 2 cyclones, for example, that hit Mozambique. It can come from gradual global warming, where we see sea levels rise, or where we see temperatures just be too hot for activities to occur outdoors, right? And this impacts supply and demand, it creates shocks, and it impacts general growth. But there's another risk, and this is why I think that I don't have as optimistic a view as I would like to have about China, India, and Russia, and other countries like that. It's because the transition risks are expensive. So economists think of an economy as containing a finite supply of scarce resources. And so if companies are taking capital and diverting it from things like medical research or artificial intelligence research or other types of R&D expenditure and putting it towards things like carbon capture, right? Economists view this overall as actually a drag on GDP. And it's expensive. Those transition risks are expensive, and they can cause shocks to supply and demand, right? So in order for these shifts to take place, usually it requires governments to get behind encouraging those shifts, and we see that happening right now in the US. The recent tax law that was passed gave a tax credit for carbon capture. Guess where the 2 most significant places in the world where we see carbon capture occurring is happening. It's happening in the US, it's happening in Australia. And it's just beginning, but if it continues, and if that technology progresses, for example, the way we've seen renewable energy progress, I think there's a lot of hope for this technology. But it's not going to start, most likely, in the emerging market economies because the transition risk is too high. Okay, this is an estimation of what happens if we do nothing. This was put together by Nobel Prize-winning economist Bill Nordhaus, and it is a survey of all of the different studies that have been done by economists on climate risk, and the size of the bubble indicates the confidence in the robustness of the analysis. And so you can see that at 1 degree increase, we're not looking at big declines in GDP. But if we get out to 2 degrees of increase, we could be looking at 2 percentage points off of GDP. And in a world that's only growing at 3.6%, that is pretty significant. So what are the solutions to this? Because I'm not going to present you with a problem without talking about the solutions. And there are a multitude of solutions that can occur. So we have energy efficiency, which we know has been increasing and is likely to continue increasing. We have the deployment of renewables, which again has hit a tipping point and is likely to continue going. We have fuel switching, so switching from a coal to a natural gas and other types of fuel switching. And finally, we have this tiny little sliver that's carbon capture. And I think there's a strong possibility that that forecast is going to turn out to be too pessimistic. So when we think about how do we deal with this gray rhino, how do we make it recede into the distance, it's really up to all of us in this room to ensure that we have not only a thriving industry, but a thriving global economy.